Imagine intentionally shrinking your business, like literally turning away millions of dollars in potential revenue,
Right.
letting your overall portfolio just contract, and then, walking into an earnings call expecting Wall Street to actually applaud you for it. I
Right.
mean, it sounds completely counterintuitive.
It really does. I mean, in almost any other industry, shrinking is, well, it's the first sign of a death spiral.
Exactly.
But in the current economic environment for a specific type of financial institution, shrinking the right way is actually a highly sophisticated, offensive maneuver.
And that is exactly what we're getting into today. So welcome to the Deep Dive, where we are looking directly at you, the ever-curious learner.
Yeah, glad to be here.
Today, our mission is to open up the hood on Columbia Banking System's first quarter 2026 earnings presentation. This source material just dropped on April 23, 2026.
Fresh off the press.
Right. And look, I know corporate earnings reports are literally designed by management to make the company look, well, as good as possible. They're inherently self-promotional, you know?
Oh, absolutely. It's a marketing document in a way.
Yeah. But if you strip away the corporate speak and just look at the raw mechanics of what they're doing, you get a fascinating look at how a regional bank operates behind the scenes in 2026.
You really do. We are looking at an institution that is fundamentally redesigning its internal engine. They are dealing with post-acquisition growing pains, deploying some surprisingly aggressive tech, and making very deliberate, almost ruthless choices about who they actually want to lend money to.
Okay, let's unpack this, because we need to establish the physical reality of this bank first. Columbia is not just, a couple of ATMs in a strip mall somewhere.
Definitely not.
They operate across an 8-state Western footprint: California, Nevada, Utah, Arizona, Colorado, and in the Northwest specifically, Washington, Oregon, and Idaho. They are the top regional bank there.
Right, with nearly a 10% market share in the Northwest.
Yeah, which is huge. And across that entire 8-state board, they are the 4th largest regional bank headquartered there, managing $66 billion in total assets.
And that geography is arguably the most important piece of context here. I mean, a regional bank's success is entirely dependent on the economic health of the specific dirt it sits on.
So true.
And Columbia happens to be sitting on very, very lucrative dirt. According to the data in the presentation, the household income in their footprint is 110% of the national average.
And it's not just wealthy, it is actually accelerating. The presentation notes a 5-year growth rate for household income in their markets at 13%.
Wow.
Yeah, compared to a national average of just 11.3%.
Which tells us exactly why they're fighting so hard for this specific territory. When you have a population with accelerating income, you have businesses expanding to serve them.
Right.
That means more commercial loans, more equipment financing, and higher deposit balances. They are fishing in a highly stocked, rapidly growing pond.
I love that analogy.
But, capturing that growth requires enormous operational capacity, which leads directly to their August 2025 acquisition of Pacific Premier.
All right, let's get into the Pacific Premier integration. Because absorbing another bank is notoriously messy. I mean, absorbing another bank's entire system is like merging 2 massive highway systems without stopping traffic.
That is a very accurate way to put it. It's chaotic.
You are talking about entirely different databases, overlapping branch networks, and thousands of employees who are used to doing things a certain way.
Yeah, and it usually takes a massive toll on the customer experience.
Exactly. But according to this Q1 report, they completed the systems conversion and consolidated 9 branches this quarter. And they say they are on track to realize all related cost savings by June 30th, 2026.
What is remarkable about that timeline is the lack of customer attrition. Usually when a bank undergoes a massive systems conversion, things just break.
Oh yeah, debit cards stop working.
Right, routing numbers get confused and customers just leave out of pure frustration. But the numbers here show the exact opposite.
Yeah, this really caught my eye. Right in the middle of this supposedly chaotic conversion, in February 2026, they launched a retail and small business campaign.
And the results were wild.
By mid-April, that single campaign had brought in nearly $450 million in new deposits. How do you keep the engine running and bring in new money during that phase?
It's impressive. It proves out their internal thesis of what they call community banking at scale.
Okay, break that down.
The mechanism here is interesting. They are trying to offer the localized, handshake-heavy relationship of a neighborhood community bank, but backed by the balance sheet of a $66 billion powerhouse.
Best of both worlds.
Right. generating $450 million in deposits during a systems overhaul, suggests the local bankers maintained enough trust with their clients to keep the money flowing in, while the IT department was frantically rewiring the house behind the scenes.
But that brings up a really massive logistical question for me. Handling an 8-state footprint and digesting a whole new bank's worth of capital usually requires hiring a small army of new back-office staff.
You would think so, yeah.
So how do you scale up that quickly without your overhead costs absolutely eating you alive?
Well, you don't do it with human capital. You solve that problem with a quiet, aggressive technological overhaul.
Ah,
If we look at their operational metrics, Colombia is essentially trying to function like a Silicon Valley fintech startup, but wrapped inside a traditional regional bank.
here's where it gets really interesting, because the numbers on their efficiency initiatives are kind of jarring.
They really are.
They took their business online banking enrollment process, which historically took 2 full days of paperwork, manual review, and data entry, and compressed it down to just 2 minutes.
2 minutes. It's crazy.
I mean, it occasionally takes me longer to reset a forgotten streaming password than it now takes a commercial client to open an account with them. We usually picture regional banks as giant filing cabinets and handshakes. But upgrading an onboarding process from 2 days to 2 minutes is like swapping a dial-up modem for fiber optics while keeping the friendly neighborhood technician.
What's fascinating here is the mechanism driving that 2-minute onboarding. It is entirely automated identity verification and instant credit decisioning algorithms.
So no human is checking the paperwork.
Exactly. But the speed isn't just a gimmick. For a commercial client trying to make payroll or move funds quickly, 2 days of friction is a deal breaker.
Right.
By removing that friction, they immediately become more competitive against the mega banks. It's not tech for tech's sake.
And it isn't just onboarding. The presentation leans heavily into artificial intelligence. Now, I have to be honest, anytime a corporate deck in 2026 throws around the phrase AI-powered, my skeptical radar goes off.
Oh, for sure. It's everywhere.
It is the ultimate investor buzzword right now.
Yeah.
So what are they actually doing, or are they just fluffing the slide deck?
It is a fair question, but they list very specific functional deployments. For instance, they use AI-powered smart leads for predictive analytics.
What does that look like in practice?
In plain terms, the AI is analyzing the cash flow patterns of their business clients. If a business's transaction history suggests they are ramping up inventory purchases ahead of a busy season, the AI flags that account. Yeah, and then the local banker gets a notification to call that client and proactively offer a line of credit right before the client actually realizes they need it.
Okay, so it acts as an invisible assistant for the relationship managers, just pointing them exactly to where the need is.
Exactly. They also have virtual assistants handling the routine stuff in their contact centers, and they are even using AI for automated code generation.
Wait, automated code generation inside a regional bank?
Yes. When their internal IT team needs to build a new tool or patch a database to integrate Pacific Premier's legacy systems, they are using AI to write the baseline code.
That is wild.
It drastically accelerates their application development. They are also rolling out instant payment platforms and Zelle for business.
But again, to what end? Is the ultimate goal just to fire a bunch of tellers and replace them with algorithms to save a few bucks?
No, and that's the key. If we look closely at their business bank of choice operating strategy, the goal is actually reallocation, not just elimination. By automating the data entry required for a 2-day onboarding, they remove the administrative burden from their staff. They are taking the human capital they already have and forcing it out of the back office and into the community.
So the computers do the paperwork.
Right. The premise is that algorithms handle the transactions while humans handle the relationships.
And that combination, ruthless technological efficiency paired with high-touch relationship banking, sets the perfect stage to look at the actual financial results.
Yeah.
Because we need to return to that crazy concept we started with, shrinking to grow.
Let's look at the first quarter financial highlights. Net income hit $192 million on a GAAP basis, or $209 million on an operating basis. Diluted earnings per share came in at 66 cents. But the most intriguing metric is what they classify as balance sheet optimization.
So what does this all mean? Wait, isn't the entire fundamental purpose of a bank to lend more money?
You'd naturally think so, yeah.
Because their average loan balance has actually contracted slightly. They shrank down to $47.7 billion. Why are they presenting a shrinking loan portfolio as a massive strategic victory?
Because it is the difference between revenue and profitable revenue. Columbia is intentionally allowing what they call below market rate transactional loans to run off their books.
Okay, let's break that down mechanically. For the learner, what is a runoff?
Say the bank issued a 5-year commercial loan back in 2021 when interest rates were near zero.
Right.
That loan is yielding a tiny return. When that loan matures in 2026, instead of trying to renew it or extending new credit to that same low-yield borrower, the bank simply collects the final payment and lets the relationship end.
To let them walk away.
They are willingly letting the asset disappear.
It's basically like a landlord who has a tenant paying way below current market rent. When the lease is finally up, the landlord doesn't renew it.
Perfect analogy.
It creates a temporary vacancy. The building technically has fewer tenants, but it frees up the space to either bring in a new tenant paying 2026 rates or to sell the unit entirely.
That is exactly the way to look at it, because keeping low-yield, non-relationship assets on the books actually dilutes their overall profitability.
How so?
Well, when a bank holds a loan, they have to fund it somehow. Often they fund it through wholesale borrowing, meaning they borrow money from other institutions at current, higher market rates to float their own operations.
Which is a terrible position to be in. You don't want to be borrowing money at 5% to fund a legacy loan that is only paying you 3%.
Precisely. It's a losing game. So as these unprofitable loans run off, Columbia takes the cash they get back and uses it to pay down their own expensive debts.
Ah, okay.
The presentation notes they reduced their wholesale funding by a massive $560 million just between December and March.
Wow.
They are shedding unprofitable assets to eliminate expensive liabilities.
So they're choosing margin over volume. And you can see it in their net interest margin, their NIM.
Yeah.
It's sat at 3.96% for the quarter.
Which is quite strong.
Now, I did notice that is slightly down from 4.06% in the previous quarter. But the presentation has a footnote about it being impacted by non-repeating items. Wait, let me read this exact phrase.
Go for it.
Impacted by an 8 basis point premium amortization on acquired time deposits. Okay, pause. That sounds like a spell you cast to put an accountant to sleep. In plain English, what does that actually mean for the bottom line?
It is pure accounting friction from the Pacific Premier acquisition. When Columbia bought them, they inherited some high-interest CDs time deposits.
Okay.
Accounting rules require banks to record the premium value of those inherited accounts and slowly amortize or expense that cost over time. It is a paper penalty.
Ah, so it's not cash going out the door.
No, not at all. It makes the current margin look 8 basis points lower than the actual cash reality of the bank's daily operations. If you strip out that accounting noise, their core margin is incredibly resilient.
And the ultimate proof that management genuinely believes in this shrink-to-grow strategy is what they are doing with their own stock. In the first quarter alone, Columbia bought back 6.5 million shares of their own common stock.
That is $200 million in capital returned directly to shareholders.
At an average price of $30.74.
Yes. And they still have $400 million left in their repurchase authorization.
I mean, you do not buy back over 2% of your entire outstanding share count in 3 months unless you are absolutely certain your balance sheet is bulletproof. It is a massive signal of confidence.
It is a very aggressive, offensive financial maneuver, but you can only play offense like that if you have an absolute fortress of a defense.
It's true.
Because while they are optimizing their margins internally, the external economy is still incredibly volatile.
Which brings us to the inevitable elephant in the room. You cannot talk about regional banking today without addressing the dual terrors of bank runs and the commercial real estate market. The headlines make it sound like every regional bank is teetering on the edge of collapse.
It is the inescapable context for the industry right now, But the granular data in this specific report paints a very different picture of their risk profile.
Let's hear it.
Let's start with liquidity, which is the ultimate defense against a bank run. Columbia reported $27.1 billion in total available liquidity.
Meaning cash sitting at the Federal Reserve, unused borrowing capacity, highly liquid securities money they can access essentially immediately.
Correct. And to put that $27 billion into perspective, it covers 129% of all their uninsured deposits.
Wait, really? So, if literally every single person in business that had an account balance over the FDIC limit decided to panic and withdraw their money on the exact same Tuesday afternoon,
Be fine.
Columbia could pay out every single dime and still have billions in liquidity left over.
Yes. And the mechanical likelihood of a mass panic like that is extremely low anyway because of how diversified their deposit base is.
Right.
They hold $53.5 billion in total deposits, but the average customer account balance is just $44,000.
That is a crucial distinction. We saw other banks get into trouble because they were reliant on a few dozen volatile tech billionaires or massive venture capital funds holding hundreds of millions in single accounts.
Exactly. Concentration risk.
If 3 of those guys get spooked, the bank collapses. But Colombia is built on hundreds of thousands of stable, everyday small businesses and retail accounts. It takes a lot more to spook 100,000 dentists and plumbers than it does to spook one hedge fund manager.
Which secures the liquidity fortress. But the second, perhaps more complex fear is commercial real estate, specifically the office sector.
Oh boy.
Since the permanent shift to remote and hybrid work, commercial office buildings have been widely viewed as toxic assets.
Right, because if the tenant's employees are working from home, the tenant doesn't renew the lease, the building owner defaults on the mortgage, and the bank is left holding a massive empty skyscraper they can't sell.
That's the nightmare scenario.
So how exposed is Colombia to that specific chain reaction? Everyone talks about the commercial real estate market like it's a giant iceberg waiting to sink the banking industry.
Well, the management team addresses this head-on in the presentation. First, loans secured by office properties make up only 7% of Colombia's total loan portfolio.
Okay, so it's a small slice.
It is a strictly contained exposure limit. Second, and more importantly, they are not financing massive, risky downtown skyscrapers.
What are they financing?
The average office loan size in their portfolio is incredibly small, just $1.4 million.
Looking at Colombia's numbers, they aren't steering the Titanic. They are navigating a fleet of nimble $1.4 million speedboats.
I like that. It fundamentally changes the risk profile.
It's the difference between financing a 100-story glass tower, where losing one anchor tenant bankrupts the entire building, versus financing a single-story suburban medical park. Right.
Exactly. Or a local accounting firm's office space. Those smaller, specialized properties are far less vulnerable to the remote work trend.
That makes a lot of sense.
If we connect this to the bigger picture, it points directly to disciplined underwriting. When Colombia originates a loan, they actively stress test interest rates and cash flows at the very inception.
So they plan for the worst from day one.
They cap the loan-to-value ratios aggressively. And the mathematical result of that discipline is undeniable. Within that specific office portfolio, loans that are 30 to 89 days past do represent exactly 0.08%.
0.08%. That is literally a rounding error. It means virtually everyone is paying their mortgage on time.
Right.
And for the overall bank portfolio, net charge-offs, meaning loans they actually had to write off as a loss, are sitting at a negligible 0.19% of average bank loans, outside of one specific equipment leasing portfolio.
But even with those microscopic delinquency rates, banking is about preparing for the worst-case scenario. And they have built a massive, quantified safety net.
Let's talk about the safety net.
They hold a $478 million allowance for credit losses. That is hard capital held in reserve.
Plus, they have a remaining credit discount on acquired loans of $133 million.
Yeah.
So when you combine those, that is $611 million in total loss absorption built directly into the balance sheet.
They are carrying an umbrella, a raincoat, and a life raft, even though their specific data shows the sun is shining.
I love that.
It is proactive risk management that allows them the freedom to aggressively pursue their strategic goals, like those massive share buybacks, without worrying about a sudden economic shock taking them out.
So, bringing this all back to the surface for you, the learner. Colombia Banking System's Q1 2026 earnings presentation gives us a blueprint of the modern regional bank. They aren't trying to win by just inflating their balance sheet with garbage loans.
No, not at all.
They are winning by getting smarter.
They are automating the administrative friction with AI, shifting their human capital toward relationship building, and intentionally shedding unprofitable assets to optimize their margins.
All while maintaining a highly granular, deeply liquid defense against the broader economic anxieties. It completely flips the narrative of the struggling regional bank.
It really does, and that raises a broader question, something to mull over as we wrap up.
Let's hear it.
If a regional bank like Colombia can deploy the exact same cutting-edge AI and 2-minute onboarding technology as a massive global megabank,
But they can do it while still offering the safety, the specialized local market knowledge, and the direct relationship focus of a community lender.
Exactly.
Are we on the verge of a massive consumer and commercial migration away from the Wall Street giants? If the friction of switching banks is reduced to 2 minutes and the technology is at parity, the only differentiator left is trust.
And that might just be the regional bank's ultimate competitive advantage?
Keep that in mind the next time you see a wall of corporate numbers. Find mechanics underneath, and you'll usually find the real story.